Some active shops, Nate, are choosing to compete against the rise of passive by offering direct indexing. Eaton Vance, for instance, owns Parametric. Explain exactly what direct indexing is and why it's appealing for the active side.
Yeah, so I think most people are familiar with index-based mutual funds or ETFs, where you have all of the securities in a particular index. You own those in a single bundled product, typically at a very low cost. And all of the back end is handled for you. The trading, rebalancing, any corporate actions, very simple. Every investor is going to have the same experience. What direct indexing does is it removes that fund wrapper. Instead of owning the securities in a single bundled product, you own the securities direct. And what's happening is barriers have come down that have previously made direct indexing less feasible. So we've seen all of the major brokerages now go to commission-free trading, which has reduced a major cost of direct indexing. And there's a report that Schwab may offer fractional shares. I think most of the major brokerages are expected to follow in offering fractional shares. So that's brought down that hurdle. I think what's happening is asset management has become so commoditized that I think a lot of advisors are looking for a way to potentially add value.
Right.
And so they're looking at direct indexing as a potential solution.
So as an advisor then, would you use direct indexing?
So I have several concerns around direct indexing. First and foremost is if you're taking an index, and what direct indexing does is it allows you to start with let's say the S&P 500, and let's say you have ESG views, or you have you don't want to own gun stocks. You can start tinkering with the index and removing those holdings. Well, in my mind, the more you start tinkering with the index, and the more you customize that index, the more that's active management.
Yeah.
And you're going to start running into tracking error.
Yeah.
And I think that's a concern for investors.
Absolutely, and even you mentioned ESG, which is a good example because a lot of clients are requesting ESG specifications, but how many really request for direct indexing specifically? Because the tracking error starts to become a big issue, right? They can't keep pace with the S&P 500. I just think of SUSA, the iShares Select Social Index Fund, which has underperformed by about 35 percentage points since inception. Like, how many people can really handle that day in and day out?
Well, and I think that's what it gets back to is investor behavior. What can an investor stomach? And I'm not here to argue the merits of active versus passive management, but the fact is when an investor starts deviating from an index benchmark, they may not be able to stick with that over the long term. But I think that's a real concern. Another benefit that's often touted with direct indexing is the ability for tax alpha. So you can directly tax loss harvest individual securities. Well, I think the data out there right now is inconclusive. And as you start drilling down, at some point you're going to run out of stocks that you can harvest for a loss. And the other part that plays into that is the more you tax loss harvest, the more you're going to start deviating from that benchmark index, which gets back to the investor behavior side of the equation. All
right, so there's always a cost here, and of course people have to be mindful of all of that. Another way that active is looking to target advisors is with non-transparent active ETFs, the Precidian wrapper essentially. These are set to launch next year. What are your thoughts on those products?
I am still skeptical on the long-term prospects of non-transparent ETFs. The reason why is if you look over the past 10 years, we've been moving towards transparency. And right now, there are active, transparent ETFs that exist on the market. There are shops that are doing this pretty well. ARK Invest and Davis come to mind. I think as an investor, if you can have a transparent active wrapper or a non-transparent, which would you prefer?
All things being equal.
All things being equal. And if you look at, just as at a high level, the move has been away from active management as a whole anyway. So I just wonder how much traction these will be able to get. Now, if we have a mass conversion where if you're a traditional active fund shop and you can take your mutual fund, convert it into a non-transparent wrapper, if they're willing to do that, certainly these could initially have assets. But I am skeptical in the longer term prospects.
Nate, one area that seems to have worked for old school active is converting their secret sauce, their magical ingredients, into an index through smart beta. This is seen as kind of a savior. Does this work, and do you use any?
Good question. So we do use some smart beta. The way we view this is as the automation of active management. So this is active management, but you're removing the human bias and emotion inherent in active management. I think the key here is, I'm going to go back to what we talked about with direct indexing. It's investor behavior. Does the investor understand the type of experience they're going to get? in that smart beta product, and are they willing to stomach that over the longer term? I think as long as that smart beta ETF solves a particular client problem in a portfolio, there's absolutely value to them. Whether you want to look at low vol or value or dividend, there is value there. But again, the client has to understand what the rationale is for that product and be willing to stick with it.
Right, understand their tolerance for pain and risk.
Absolutely.